Hello, everyone. Thank you for inviting me to this poster presentation session. My name is Jian. I'm currently a PhD in the Joint Program of Financial Economics at the University of Chicago. I will be joining Columbia Business School as an assistant professor in finance this upcoming fall. I study topics in the intersection of macroeconomics and finance, and particularly interested in how different types of financial institutions contribute to financial instability and how they affect the real economy. In this paper, we look at how investor composition affects the pricing of liquidity in the corporate bond market. Our work is motivated by the fact that investors are widely worried about liquidity, even though bid-ask spreads and other standard measures indicate liquidity has not been deteriorating. As a potential reconciliation, we establish a new fact that the cross-sectional sensitivity of credit spreads to bid-ask spread has increased 3 to 4-fold between 2005 to 2019. As a result, the liquidity component of credit spread has gone up from less than 10% to over 25% today. To establish this, we regress credit spreads on bid-ask spread with controls period by period. We then plot the coefficients in front of bid-ask spread over time. As you can see here, for both investment grade as well as high yield bonds, a given amount of difference in bid-ask spread today is mapped into much bigger difference in credit spreads compared with 15 years ago. After the COVID-19 bond market disruption in March 2020, we generally agree that the bond market has become more fragile compared with 15 years ago. However, ex ante has been hard to find any evidence ex ante. You can think of our exercise here as proposing a new leading indicator that tells us the market now is responding more strongly to the secondary market disruptions. So to explain this, we built a heterogeneous investor model linking this increase in sensitivity to the observed rapid growing mutual fund participation. Mutual fund shares has doubled in the past 15 years. The biggest difference between mutual funds and traditional investors, such as insurance companies, is that mutual funds trade much more frequently. To capture this, our model features a continuum of investors with different trading needs, and they choose whether to hold risk-free liquid assets or to hold illiquid bonds. Bonds are illiquid because of surge frictions as well as bid-ask spreads. In the model, we show that as the risk-free rate declines, more short-term investors, such as the mutual funds, enter the illiquid bond market reaching for yield. This entry has two effects. First, the increase in market participants makes it easier to find a counterparty, which lowers the level of bid-ask spreads, consistent with the data. And second, the newcomers have higher trading needs, which amplifies the effect of bid-ask spreads on credit spreads. So intuitively, if the bond is held by a long-term investor who never have to trade, then he doesn't care about secondary market frictions and credit spread will not reflect it. But if the bond is held by a short-term investor who transacts frequently, then he encounters large transaction costs and requires compensation in credit spreads. That's why we see a stronger relationship between credit spreads and bid-ask spreads when there are more short-term investors in the market. Excuse me. Apart from matching the time series results, the model also has cross-sectional predictions that we test in the data. Using detailed investor bond holding data, we find that short-term investors hold more short-term and riskier bonds, and bonds held by short-term investors are more sensitive to bid-ask spreads, both consistent with model predictions. At the aggregate level, the model says countries with larger decline risk-free rates should be associated with faster growth with bond mutual funds. We confirmed this using international data. In the last section of the paper, we use the calibrated version of the model and conduct two counterfactual analyses. First, we examine the Volcker rule. Volcker rule is thought to have increased dealers' inventory cost and worsened market liquidity. We want to understand does the mutual funds entry amplify or alleviate this concern. On the one hand, they make the market or credit spreads more sensitive to secondary market frictions, which potentially amplify the regulation impact. On the other hand, they serve as counterparties for a lot of the trades. So the market relies less on dealers to intermediate the trades, which alleviates the regulation impact. We find the second force dominates, which means the entry of mutual funds is actually masking the negative impact of dealer regulation change in a normal time period. The second counterfactual, we examine aggregate liquidity shocks, and we find the same magnitudes of aggregate liquidity shocks lead to about 20% more increase in credit spreads today due to the presence of more short-term investors. Our results highlights the key role that investor heterogeneity plays in determining how liquidity is priced into bond yields and ultimately affecting firms' financing conditions. We think this is important for understanding the impact of dealer regulation, as well as different quantitative easing programs, as both of these would shift investor composition in the underlying market. Thank you so much for your time and attention.